Family radio for a really great future. We're talking real money.
Suddenly, the real estate market is... Suddenly. Over the past few years, the real estate market has changed dramatically in America. It's some really interesting stuff going on that you need to be aware of, about mortgages, about people staying in their homes, and what it means for this big financial part of your life, which is something we talk about on this show called Talking Real Money. So, we talk about money stuff. Hi, everybody. I am Don McDonald. Over there in the room that's too hot in Bellevue, which doesn't make any sense because it's winter in Washington, is the grumpy Tom Cock. Too hot. It's too cold. It's never just right.
Hi, Don. Good to see
Goldie.
you, too. Always a pleasure.
It's good to see you. Interesting fact. This was just recently in the news on CNBC and elsewhere. Demand for mortgages over the past few years has fallen pretty dramatically. Rates have come down a little bit, not to the low point where I got my mortgage and locked it in, but the number of people taking out mortgages is down, and the real estate market has gone through some pretty dramatic changes of late.
I would say very dramatic. I would actually say going back to COVID, which is hard to believe that is 6 years ago, that things really haven't been right since then, right? Because you did have this plunge of interest rates to the point where people ended up with 2% 30-year mortgages, which made them less likely to move. You mentioned the fact that people are staying in their homes longer. They're staying in their homes an average of 12 years, which is about double what it was 20 years ago. So that in and of itself, as one fact that would be so huge in terms of the inventory available, right? Inventory down, fewer listings. People are still not building homes the way they used to. That's down. That number is astounding. I looked this up. It's down. The new home construction's down about 40% from where it was in 2008. That's
a pretty dramatic drop.
That's huge.
But what would be there got to be some intrinsic economic reasons for these dramatic changes, because apparently there's still some demand, but the supply is not increasing.
Yeah, well, there's a couple of things. First of all, the fact that real estate, and I know every market is idiosyncratic, right? But in a big picture sense, especially on the coasts, real estate values have gone up pretty dramatically the last decade. Therefore, the income that you need to buy something, this is the average, nationwide average. 2021, it was $79,000, right, that you needed to have for income to buy a home of some sort, of an average type of home. 2024, that's up to $126,000. I mean, that tells you a lot right there.
So that's cutting a huge part of the population out of the housing market.
Massive. Yeah. And
really, you'd think, even today, if you were making $100,000 a year, that's pretty good money. You could afford an average house. But no, that's not what they're saying.
No. And what's that done to first home buyers? Not only fewer of them, they're much older. First home buyers used to be in their 20s. I think the average now is somewhere close to 40. You mentioned mortgage rates coming down. Well, they're not coming down to the extent that they did again.
Back
to COVID.
Bit.
Yeah, I mean, I guess you could get a mortgage now under 6, which is still better than where it was a year ago when it was in the high 6s, I suppose. But all of this is again sort of led to this situation, and this is not a breakthrough thing to know here. But the market is kind of frozen, right? There's not that much inventory, fewer listings. Home prices, by the way, have not appreciated the last couple of years the way they had prior to that, certainly. And so inventory low. What people ask me is what to do.
It feels like, though, kind of an Alice in Wonderland kind of market where you've got this high demand. You've got no one meeting the supply. You've got no one moving out of their houses, and yet prices of houses aren't going up that much. You would think all the laws of economics say this kind of a scenario shouldn't happen.
Yeah, but the reality there, because fewer people are getting mortgages. In fact, reading this article is astounding that half of the homes in Baltimore over the last few years, the home purchases, half of them had no mortgage. People just paying all cash, which is, again, that's going to eliminate a lot of people from getting out and doing this. But I think still the bigger picture sticking point for both people selling their homes and people buying their homes, Don, is the fact that a 30-year mortgage is about 6%. And people with perspective say that's not that much because I paid, I think it was 13 for my first mortgage a long time ago.
Yeah,
that was expensive
too.
But when you compare it to 2 a few years ago, people say, well, I don't want to pay 6 when people were paying 2. Well, that was then, this is now. But I've seen this up close, and you know this. We've discussed this. My brother was just here trying to buy a home in the Seattle area, moving from the Midwest. And frankly, it's a nightmare because he has a limited budget, right? He has it, as we all do.
So he has a Midwestern budget
and wants
Seattle
to live on the
desire.
coast. Yeah, I know.
Yeah, those don't match up.
No, they don't match up at all. He took one day and went out and saw 13 homes, none of which he thought were appropriate. Took the next day, went and saw another 6, and there's one possibility, I guess, out of the 6 that maybe will work. But my advice to you is the same as I'm going to give to him, and that is wait. I just think if you're moving somewhere, why not rent for a year? Rent for some time. Kind of get a feel for what the market's like and see what's going to happen. Now, we don't know. It could get better. It could get worse. There's a lot of suggestions that later this spring, more inventory will open up, et cetera, but nobody knows that, right? There's no guarantee to that.
That's all guessing. That's all guessing.
That is guessing. But the other part is, and in his case, sadly, I think it's going to be true, is probably have to be more flexible, both in terms of the type of housing and the location. He was looking at one very specific place, and I said, you might have to go look somewhere else in the Seattle metro area because
what area was he looking at?
He was looking at, like the northern part close to us and, east, northeast of the greater metropolitan area.
Wait, hold on. You live out in the middle of nowhere.
Mine, you go to Chicago and then you go further east.
Yeah.
Right? You keep on going. So, yeah.
I have an idea.
Really?
For him. No, this is really solid advice. I can help him out.
Good.
How big is his family?
You have $100K you're going to give him?
How big is his family?
It's the 3 of them.
Three people. That's it. So there's nobody else.
That's it.
I have an Airstream. 1989 Excel.
I knew this would somehow end up being about
condition.
You.
Now think about this for a minute. What can you get a nice piece of land for up in that neck of the woods? Just a piece of land.
Relatively inexpensive.
I'm thinking Grey's Anatomy here a little bit.
You're going to set it up in somebody's backyard?
If you saw Grey's Anatomy, you know that the doctor, I think the one who was called McDreamy, he lived somewhere in the Seattle area on a piece of land with his Airstream.
And how many square feet is the Airstream, if I can ask?
Oh, I don't know. It's like 100.
Which is a little less than what he's been looking for.
But you build a big deck. You build a big deck. Covered deck.
Which you can, as you know, in Seattle, go outside those 4 or 5 days a year.
That's why I said covered deck.
Summer. So, okay.
With a nice view.
You're agreeing with me.
You buy in the view.
You're agreeing with me. You got to be flexible, both in terms of the style of house and the location. But I mean, the other part is, and this goes to people that are in or near retirement, you may have to help others if they're going to try to crack into the housing market. I know. Your eyes are getting big.
Wait. What does that mean?
Give them money, that kind of thing, help them out?
You got to give people money?
Apparently so, because otherwise they're not going to be able to. Or maybe we've discussed this as well. Maybe the better financial decision long haul is just be a renter.
Well,
right?
Okay. I'm going to come back to the renter thing, but I gotta stop you here at the who's giving away free money?
I'm first in line, by the way, for anybody.
No, you're not. You're way down the list now, but your brother's ahead of you.
Don't we have a chief wealth officer in this company? I could call him. Can't he give away some money?
That's not a good answer, but I do think renting is. I really do think renting is the European answer.
It is.
It really is. Home ownership is not. It's a very American thing. That's part of the, I think, mistaken American dream. You own a piece of land, you build a house, you live there, you make a lot of money on it, but the reality hasn't been matching the dream lately. And as we've just discussed, and long term even owning a home. The only reason it appears that you make a lot of money owning a home over short periods of time is when you're in a rising market and you have a lot of leverage.
Yeah,
you borrowed a lot of money.
Good. Well, we've discussed that too, because when I sold my place a year and a half ago, remember we ran the ROI, it was like 3%.
Yeah.
It really wasn't very good. By the
It's
time
not
you
a great investment.
No.
So if it's about living, find a nice place to live that you can rent. Because if you think this is an argument I hear from my wife now and again, because I keep saying maybe it's time to get a one-bedroom condo, and she goes, well, what about the special assessments? And I said, what about the new air conditioners I've put in over the years and the painting and the new roof and the siding repairs?
And don't you
and
pay
the trim
property
repairs?
taxes there, that kind of thing?
Well, no, she's talking about the special assessment when the condos have to rebuild
those are
something.
fun. Yeah, sure.
But I get a special assessment every couple of years when I have to put something like a roof or a new AC in.
Yeah.
It's not like owning a house is a fixed cost.
No.
One of the arguments is, well, I don't want to rent because the price will go up. Your house is not a fixed cost.
It's going to have variable things, that'll come into play.
And surprises. You're going to get bigger surprises with a house than you're going to get with regular rent increases.
I think that's fair. Yeah. So anyway, this whole situation is unsettled. Stay tuned. We'll see as it gets better, if it gets better. I meant to say, and I think the only thing really that's going to break up the clog here, Don, is going to be a significant drop in mortgage rates, which no one feels is on the horizon.
And I don't think that's worth waiting for as a solution. As a matter of fact, it may be that there is an evolutionary change or evolutionary change, potato, potato, going on in the housing part of our lives. I'm not going to even call it a business. It's the housing is a huge part of what we need as human beings. And there are various ways to approach that. And we may be entering a period where the more sensible way to approach that for most people, those who don't have a ton of money, is going to be renting.
Out of your kids, how many own homes? Because they all have one now, right?
2. 2 out of 4.
Okay.
Two out of 4.
There you go. Maybe that's where we're headed.
And one of those is because they got a lot of help from somebody.
Didn't you just say something about anyway? Okay,
family members. That's the only source. I think that's the only source. Is if you got a parent who's helpful. Not me. It wasn't me they turned to. Trust me, it was not me. It was the other side.
Just checking.
Yeah, you're not me.
Hard, you know what. All right, questions come from TalkingRealMoney.com. We love them. And from Boston, Massachusetts, Chris writes us, "Hi, Don and Tom. Love the podcast. Appreciate your consistent advice over years of listening. I'm an extremely disciplined investor. I have a factor-tilted portfolio split between Avantis and Vanguard funds, rebalanced with new contributions, track rebalancing based on 525 rebalancing rules, and split 60-40 U.S. International. I treat all of my investments as one and optimize asset location based on fundability and taxes."
Then why is he asking us a question? He doesn't need
give this
help.
guy a high five. We're getting to that. During the depths of the pandemic, he rebalanced out of bonds into more stocks. Awesome. Mm-hmm. I say all this as to frame my question and your advice, since the name Robinhood carries certain connotations.
Yeah, a thief. Robinhood was a thief.
Robinhood,
by the way.
the company. If I say that to you, what do you say?
I thought you meant the guy in Nottingham.
What's your connotation if we say Robinhood?
Trading. I think trading and timing
trading,
the market.
gimmicky.
Yeah, gimmicky. Gaming.
Gaming.
Gamifying of investing.
Yeah.
That's what I think.
Yeah. He says the reason he's asking is Robinhood is currently offering 2% if you're a gold member for account transfers. It seems to be unlimited, although I'm going to do research to verify that. Currently, my money is at Fidelity, which works just fine. But since I'm disciplined, it doesn't really matter much to me where my assets are held. If I could transfer my eligible funds, I'd be looking at over $20,000 in what appears to be free money with only a few catches. What am I missing? Is this too good to be true? With the gold member at Robinhood, isn't Robinhood the one they're going to, where you can call them up and they'll bring you money during the day or something too, right to your house with the
that was the one in jolly old England, I think.
Yeah. So the good news is, yes, they still have the 2% offer.
Yeah, if you transfer $1 million They give you $20,000.
How about $2 million?
They give you $40,000.
A lot of money, yeah.
If you transfer $10 million, they give you $200,000. You have to keep your assets there.
How long?
For 5 years.
Okay.
So for them, what they're looking at, and this actually kind of makes sense. They're doing the cost. They're going, what does it cost us to get a new client? And they calculated it out that over 5 years on $1 million, it's about $4,000 a year that they spend to get their average client.
And they're going to spend that by just saying, we're going to buy your friendship, buy your client.
I have been so tempted to do it. So many times I have been tempted. I'm going, that's a big fat chunk of free money.
It is. And who knows how long they'll do it. They could pull the carpet out at any time. So
I just don't like Robinhood. I think that's what keeps me from doing it.
Me too. Yeah, for what they stand for. But your thinking is exactly right there, Chris.
What does the gold membership cost? Let me look. Hold on.
I don't know.
Because there is an annual cost for that.
So they have something there.
You have to be a gold member, which I don't know what that gives you, but it's $5 a month. Oh my
$60
God.
a year to be a gold member? That's it?
That's it. And
then you get the $20,000?
Get this. You get, if you're a gold member, you also get a 3% match on your IRA contributions.
I think we have talked about that previously. So, wow. I think you're going to be jumping off this podcast and making some transfers.
Boy, I am so thinking
All
about
right.
it.
Let's move along. From Latham, New York, Brian writes, "Hi, Don and Tom. Found you and listen every night as I fall asleep.
That's your fault.
Some nights this happens quicker
You're
than
putting
others.
them to sleep. It's not me. I'm too excited about things. You're the level one. You're the
Sometimes this happens quicker than others. I hope this isn't one of those nights. So thank you very much.
We need some scientific information. We need data.
I'm going to take my
We need
pill.
to know which episodes are putting him to sleep
That would be helpful.
we can avoid doing whatever it is we did during that episode.
All right. Can he ask his question before he nods off?
Because we're going to put him to sleep again.
A while back, you referenced the book 1929.
Ooh, good book.
Love the book. That's by Andrew Ross Sorkin. And mentioned themes that reflect today. I just finished it myself, found connections to today as well. Money going into the market without knowing how or why the investments were performing the way they are. Markets that keep going up for reasons that cannot be understood. And possibly the biggest, news cycles and information created to keep markets moving higher and higher. I'm interested in what you saw the connections to be, and if you think these will have a similar outcome for the United States. 1929,
we never
for those
said
of you who
any of
don't know,
those things. We never said any of those things. We never would say that the market is going up for unknown reasons. No, the market always has reasons. Whether they're right or not, we don't know, but they always have reasons. The market is always trying to anticipate the next thing, whatever it is, economically. What's going to happen to various companies, what's going to happen to various economies, what's going to happen to the world in general. It is always looking forward. So there always is a reason. It is not just this random creature that moves in whatever direction it wants for no apparent reason. It's not like a worm digging in the dirt that has no idea where it is.
Plus, this sounds conspiratorial if you're saying the news cycle is, feeding that.
And we've never said that either.
We wouldn't know how that Murdoch's sitting back there feeding it or something. Who knows?
I honestly don't believe that. I think now I do believe that the financial news media is designed to help promote the beliefs of Wall Street. And their goal of moving money more, keeping money in motion, because the only way they make money is if money's moving. But that's all short-term noise. I think what he's talking about is just short-term noise.
Well, let's set the picture carefully for people who don't know. 1929 is about the events leading up to and through the crash of 1929, where the market went down quite a bit and didn't come back for several years. So that's the backdrop. And what the book implies to some extent is the amount of speculation today, the amount of sort of products that people are throwing money at and not realizing the risk they're taking, is somehow similar to there's similarities between today and 1929. I can't agree with the speculation part because I forget how much people were borrowing in 1929.
They were borrowing $900 for every $1,000 invested.
That's a pretty large margin call.
There's no such thing as that today. That's not allowed. That is not allowed.
Is it cap out at 50% today?
50%.
Okay.
That was, and we believe margin is a terrible idea anyway because it's a tool for gamblers. That's all it is. It's a gambling tool. That's exactly what was going on in the 1920s. As a matter of fact, the market was not considered a place to make long-term money. It was considered a place to gamble, to speculate. It was a legal casino. That's all it was. As a matter of fact, there were even things called bucket shops where they just traded on the movement of the market. People would come in and make bets on it. They were just betting. They weren't even buying stocks. It was a very speculative climate. The only similarity between then and now is the degree to which certain groups of people in this country continue to speculate in stupid ideas, in meme stocks, in, sorry, my crypto bros, crypto. That's all speculation, and speculation, there has always been in the past a rug pull.
It comes to an end at some point. The deadline gets there.
The deadline. It goes up until it doesn't.
Yeah. And one other key difference, I think, Brian, if you looked at, would be the regulatory environment. Of course, the Federal Reserve was around in 1929, but it was a vastly different institution then than it is today, much more controlling on a variety of economic factors that it was not back in the 1920s and 30s. So I wouldn't say they're similar. So here's what I would also say to anybody who says, well, hey, look, 2026 is going to be just like 2029. The question would be what you do if you knew that to be the case. Mm-hmm. Then would you take everything out of stocks and set it on the sideline and then buy back in at some point? How would you know when that was going to be? How would you know?
That's the problem because of the length of the 29 decline, which was exacerbated by all kinds of factors that, again, don't exist today. Mortgages mortgages could be foreclosed like that back then.
And
banks were insecure. There was no FDIC, so runs on banks caused the stock market to continue to fall. It was all a factor. It was all this giant fear snowball.
Yep.
And we just don't have a similar situation. Yes, the market will go down. I guarantee it will. I don't know how much, and I don't know how long it'll last, but it will go down. And that's why we do this simple thing, Tom. We just build portfolios for the fact that it's going to do that.
It's going to have its good days and its bad days, good years, bad years, et cetera. All right, one final question from Evans, Georgia. Brian, gentlemen, if I have a longstanding 529, which is a college savings plan, that meets the 15-year required threshold,
let's explain that. 15-year required threshold for a 529 means before you can convert it
to a Roth IRA.
It will in pieces over.
Correct.
Yeah. Okay.
Well, the max would be $7,000 a year because that's the max you can put in a Roth, and that person has to have income
that amounts to that or more.
At least that. Yeah. The current child beneficiary will not use all the funds for school. Can I reassign the beneficiaries to older employed children completed with college in order for them to legally convert the remaining funds to their Roth accounts up to $35,000 over time? Or does the 15-year established 529 account rule restart the clock upon beneficiary redesignation for the purpose of movement to a Roth? A lot there.
Boy, I got to tell you, human beings, we're thinkers. We are just, our little brains
in this
are just
case,
constantly going.
Too much.
We're always looking for an angle. There must be an angle. There's got to be a way to do this. Yeah, you can give it to your other kids, which really seems silly based on what this account is supposed to be. It's supposed to be an education account, and giving it to like a 35-year-old child seems contrary to its intent.
But
you can. It's just the clock starts again.
yeah, you have to hit the 15-year clock once again. So that would be they'd be getting it at about 50 now. So it gets to be a little silly at some point, but I guess you could.
We are a silly, silly bunch of creatures. We
Silly.
really are.
Anyway, that's an interesting strategy, and we wish you well with all of that.
We're always looking for shiny objects and new things. You know, speaking of shiny objects, I read an article today or a couple of days ago, or I don't know when I read it. What's our closest evolutionary relative in the animal kingdom?
Neanderthal?
No, close, alive, that's living today.
Oh, that's living today.
It's living today. Our closest...
I was talking about some of my neighbors.
Our closest animal cousin.
Wow.
Which is the animal that's closest to us? You got to know
ape
this.
of some kind?
Chimpanzees.
Yeah, okay. All
Okay,
right,
they
close,
share
yeah.
like 90-some-odd% of our DNA.
That's a little scary, but okay.
I know. Well, I can see you. Anyway, they did
Is it
this
the long arms?
experiment.
What is it exactly?
Speaking of shiny objects, we love shiny objects. And I was talking rhetorically, but literally, we love shiny objects. We have this attraction to things that sparkle and shine. Well, they did this experiment. With a bunch of chimps in a rehab center, they put a bunch of rocks on a board, and interspersed among those rocks were actual crystals, crystallized rocks, the pretty, shiny, sparkly ones. The chimps went nuts for the crystals. They left the rocks. They took all the crystals. They hoarded them. They played with them. They looked at them. They saw the light through them. They would not give them back to the humans.
Okay, two things, though. First of all,
Shiny
why are
objects.
chimps in a rehab facility? Part two, didn't they already make that movie, 2001? Isn't that what happens at the end when they all go nuts or something?
They actually called one of the crystals the monolith.
Yeah, okay. That's
When-
my take, but okay. You're scared
But
me
isn't
because
that curious?
we're so close to that. Yes,
this is
I
built
concur.
into us, this desire to find the next shiny object.
It's out there.
We're such predictable creatures.
Indeed.
We're chimps at heart.
That's it. I'm going to keep my long arms and start walking a little lower to the ground. So
All
that's
right.
okay.
And that's going to wrap up another edition of Talking Real Simians. Talking Real Money.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor. Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services. Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.